am Jessie, Department of Commerce. Today we are going to see some important keynotes about income tax law and practice. In that we are going to see income tax under the head salary, house property and income from business or profession. The Income Tax Act was passed in the year 1961. The first Income Tax Act was passed in the year 1922. After that, many amendments have been made and it came into existence in the year 1962. Every year there is a change in the tax as per the finance of government, and the amendment will come under category with the help of union budget. There are 5 heads of income: income from salary, income from house property, income from business or profession, income from capital gains and income from other sources. Income from salary means if an assessee received income as a salary, it comes under the category of income from salary. And income from house property is the assessee receive income from let out property, it is termed as income from house property. Income from business or profession is the income earned from business, that is from manufacturing units. In case of profession, if they earn anything by spending his knowledge, it is termed as income from profession. Income from capital gains is a gain which has been received from investment. It may be short term or long term. Income from other sources is the income which does not come under the above 4 category, comes under the category of income from other sources. Residential status. The assessee is termed as resident, ordinary resident and not ordinary resident and non-resident by considering 2 conditions: basic condition and additional condition. Basic condition consists of 2, any one of them has to be satisfied. Additional condition consists of 2, both of them has to be satisfied or not satisfied. The first basic condition is an assessee resides in India for a period of 82 days or more in the current previous year, or an assessee should stay in India for a period of 60 days in the previous year and 365 days in the 4 preceding previous years. In the second basic condition, both has to be satisfied to become the resident of India. The additional conditions consist of an assessee should stay in India at least 2 out of 10 previous year, and second additional condition is he should stay in India for a period of 730 days in 7 preceding previous year. If an assessee satisfies first basic condition and both the additional condition, he is termed as resident and ordinary resident. If he satisfies only the basic condition and not the additional condition, he is termed as resident and not ordinary resident. If he does not satisfy any of the basic and the additional condition, he is termed as non-resident. The assessee may be an individual, Hindu-undivided family, association of person or firm. In case of Hindu-undivided family, the assessment is done only for the head of the family, who is termed as Karta. As per the Karta residing in India, the status of an Hindu-undivided family will be analyzed. In case of association of person and firm, they are divided into 2, resident and non-resident only. The next one is salary income. The salary income comprises of basic salary, allowances, bonus, commission, retirement benefits and perquisites. The allowances can be classified into 3. They are fully taxable allowances, fully exempted allowances and partially taxable allowances. First we are going to see some of the partial taxable allowances. Under the partially taxable allowances, the first one is house rent allowances. The rule for house rent allowances is least of the following. They have to see 3 conditions. First one, actual HRA received. Second one, 50% in case of metro cities and 40% in case of non-metro cities of salary, and rent paid minus 10% of salary. And the above three, least of the following is exempted from tax. In case of taking out the salary percentage, we should consider three things: basic salary, DA forming part and commission. These three only have to be taken to calculate 50% of salary and 40% of salary. The metro city consists of Chennai, Calcutta, Mumbai and Bangalore. And in case of educational allowance, it is exempt up to 100 per month, maximum of 2 children. In case of hostel allowance, it is exempt up to 300 per month, maximum of 2 children. In case of transport allowance, it is available only for disabled people and the allowances will be 3,200 per month. The next one is fully exempted allowance. Under this category, the allowances is fully exempt. It is not taken into taxable salary. The fully exempted allowance is foreign allowance. The foreign allowance comes when the government employee is posted away from India. So if he stayed in foreign country or appointed in foreign country, it is termed as foreign allowance. And next one is UN allowance is fully exempted from tax. And the next one is if any allowances received by High Court judges, it is fully exempted. And next one is fully taxable allowances. Fully taxable allowances includes dearness allowance, city compensatory allowance, tiffin and lunch allowance, and servant allowance and project allowance. And some more allowances are available under the category of fully taxable allowances. The next one is Provident Fund. Provident Fund can be classified into four: Statutory Provident Fund, Recognized Provident Fund, Unrecognized Provident Fund and Public Provident Fund. The first one is Statutory Provident Fund. The Statutory Provident Fund is usually taken by government employees and it is fully exempted from tax. And second one is Recognized Provident Fund. The Recognized Provident Fund is usually provided to private employees and it is acceptable by the Commissioner of Income Tax. So income tax is accepting Recognized Provident Fund and the amount which has been invested in Recognized Provident Fund is exempt up to 12% of salary. Under this, the salary includes basic salary, dearness allowance and commission on sales. And in case of interest credited in Provident Fund account, it is exempted up to 9.5%. It is governed by the employer and EPFO or governing the Recognized Provident Fund. And next one is Unrecognized Provident Fund. It is not recognized by the Commissioner of Income Tax. And the investment can be made by the employee only and it cannot claim any exemptions for the Provident Fund. And next one is Public Provident Fund. It is acceptable by the Income Tax Department and the share will be made only by the employee and not by the employer. And after 15 years of investment in Public Provident Fund, the amount can be withdrawn in the Public Provident Fund. The amount of Public Provident Fund will be maximum of up to the eligibility of an employee and it has to be paid regularly every year in the Public Provident Fund. It cannot be claimed as deductions and there is no exemptions for Public Provident Fund. The next one is perquisites. Perquisites means any amount other than salary which has been received by the employee is termed as perquisites. The perquisites may be in the form of cash as well as in the form of fund or by giving services to the employee. Usually the perquisites comes under the category of if anything is received by the employee for his work done in the office is termed as perquisites. The perquisites can be classified into three: fully taxable perquisites, partially taxable perquisites, fully exempted perquisites. The fully taxable perquisites consist of rent-free accommodation, This rent-free accommodation is the accommodation which is accommodated by the employee if he is posted in other places of the city. Is termed as rent-free accommodation. The rent-free accommodation decides only upon the population of the area. If the population is more than 40 lakhs, then the rent-free accommodation exempted is 10% of salary. If the population is 10 lakhs to 40 lakhs, the exemptions will be 7.5% of salary. If the population is less than 10 lakhs, then they can claim 5% of salary as exempted. Under this, the exemption is claimed, the salary includes salary and if any allowances which has been received and other than the rent-free accommodation purposes should be taken into consideration to find out the percentage of exemptions for purposes. The next one is company car used for personal purpose is fully taxable in the hands of the employee. And interest-free loans, if anything has been taken by the employee, it is also taxable. Free domestic servant is also taxable in the hands of employee if he is a specified employee. Specified employee consists of three categories. If he earns more than ₹50,000 as salary, or if he has 20% voting rights, or if he is a director of a company, he is termed as specified employee. In such a case, the free domestic servants expenses are taxable as in the hands of employee. The next one is tax-free purposes. Under this purposes, the purposes is not taxable to anyone. The first one is laptop and computers used for work, medical facilities given in government hospital as well as in private hospitals, telephone or mobile bills used for office purpose, refreshment during the office hours, free education in case of employers institution. If the employees children studying in employers organization, in such a case they can claim free perquisites. The next one is partially taxable perquisites. The education facility above ₹10,000 per child can be claimed as free taxable perquisites. Partially taxable perquisites. If the motor car is used both for personal and official purposes, it is a partially taxable perquisites. Part of the expenses which is incurred for the office is exempted and which is used for personal purpose is taxable. And accommodation at concessional rates. And next one is income under the head income from house property. First, house property means the property which should have a place of accommodation and it must yield a rent for the house owner is termed as income from house property. And under the head income from house property is analyzed on the basis of the amount of income which he has been received from rent during the previous year should be taken into consideration under the head income from house property. And under the income from house property, if the owner has more than 2 houses or for example 3 houses, 2 will be exempted from tax and 1 will be taken as deemed to be let out. Remaining 2 will be exempted from tax. If the property is let out for a given period, then partially let out has to be taken into consideration. If it is let out for a 6 months, the actual rent received should be taken only for the 6 months. If the area is partially divided into self-occupied and let out, the let out will be taxable and self-occupied will not be taxable. And under the house property, the important terms of house properties are municipal rent, fair rent, actual rent, standard rent and expected rent. The first one is municipal rent. Municipal rent is a rent which is fixed by the municipality according to the information which has been received by the corporation or municipality. It is termed as municipal rent. Fair rental value is a rent which is the rent which is available in the same locality. It is termed as fair rental value. Expected rent is the rent which is expected by the house owner of the property. And finally, the house property is analyzed on the basis of GAV and NAV. GAV is gross annual value, NAV is net annual value. After the net annual value, some amount has been deducted as tax deduction, that is 30% of as standard deduction, and interest on loan can be deducted. In case of self-occupied property, the NAV till NAV it will be nil. And last one is income from business or profession. The income from business or profession, income from business is taken from profit and loss account. Income from profession is taken from income from receipts and payment account. Under the income from business, the profit and loss account is the base. Under the profit and loss account, inadmissible expenditure or the expenditure which is not related to the business should be eliminated, and the income which is not related to business should be eliminated, and we can receive the profit from or income from business. In case of income from profession, which includes from doctors, lawyers, etc. And under the income from profession, all incomes which is received by the profession should be taken, and all the expenses is related to the profession has to be taken into consideration. Thank you for watching.